bring in Greg Peters right now with Morgan Stanley to talk about caution. I thought your note was really refreshing. Lots of optimism. Even somebody like Doug Cass, who was on board this rally, is lightened up. Barry Ritholtz said today on radio, a lot of things to worry about. What's your number one caution that's out there?
I'm not sure it's one single factor, Tom. I think there's 5 things. So we have 5 straightforward reasons, as I'm labeling it. One is that the economic data are slowing. We think investors have extrapolated the strong fourth quarter, particularly here in the U.S., into the first quarter. That's too much. High oil prices obviously is a negative feedback. The European sovereign debt crisis still rages on. The LTRO has not solved the issue. It has helped out, but it hasn't solved. And then you look at just, we're in this liquidity lull, I'm calling it, from a central bank standpoint. So the ECB is taking a step back. The Fed,
love that.
You're right, the Fed made...
Liquidity lull.
I like that, huh?
It's a Petersism. Banner that, please, Peters, liquidity lull. What's a liquidity lull?
That'll be in my tombstone, I think, the way we're going. But no, it's just that central banks are taking a step back from this global monetary easing cycle that we were in the middle of, and I think that matters.
Okay.
I think that matters. So it's all hitting at once. At the same time, lastly and fifthly, valuations. Valuations have moved pretty meaningfully in a short period of time. So you put it all together, and it spells correction to me.
Dreaded first chart. Let's look at it here. Forget about the wall of worry. We're climbing the wall of cautious, and there it is. Valuations are not where they were back to August 31st of last. It's a repricing of equities. Your Joachim Fels Sunday afternoon puts out his note and talks about a complacency that's out there. Is that complacency part of the equity markets?
Absolutely. The markets, particularly here in the U.S., are very isolating right now. So it's not looking at Europe. It's not looking at other factors. It's just focused on the U.S. And it's somewhat interesting, I would say, to say the least.
What is the response of Morgan Stanley clients, both institutional and retail, when you show them caution? I would suggest a lot of people aren't in this market, and a lot of people agree with you.
Yeah, they do, but quite frankly, we've been getting beat up a lot lately as investors want to be bullish. They want to hear the positive story, and the pushback has been quite extreme. But I would say the past week and a half, you've seen a much more evening out of bulls and bears. And so, who knows? Maybe some caution is starting to creep in. Okay,
here's from your charts, which I love this, the global PMI. This is a JP Morgan series. Down we go, and just ain't where it was at 50, the yellow line. Wither manufacturing, the state of manufacturing. How do you read a global PMI, and particularly European PMIs?
To me, it's a very simple formula. Equities follow growth, and so we watch PMI. And the fact that we've seen PMI come down off of the lofty levels is important. And so I think this is a really critical story here. And that's something that we're looking at. You also, here in the U.S., you look at the surprise index. That has inflected down.
That's the Citigroup surprise index?
Yeah.
Tell me about that.
No, it's just a factor of just various components where when it inflects upward, the markets have actually moved higher, and when it's inflected downward, the markets have moved down. Except now there's this disconnect. So clearly you can't be surprised forever, but at the same time, what I think is important that that index has inflected down.
Note of the day, let's bring it up here from Mr. Peters and the team at Morgan Stanley. The note of the day, why so cautious? We're skeptical that U.S. growth can accelerate, and while more optimistic on China, uncertainty remains high. Valuations are close to long-run averages with only modest upside before becoming rich. Can we make it through record Dow levels? The fact is we just keep moving higher.
I think it's very difficult to do that as essentially all the factors have to remain in place. And to me, once again, it's about growth, and we see growth inflecting downward. Weather has been a huge boost in the first quarter.
What's your first quarter GDP? Is it 1.7? Did I read that correctly?
Yeah. So our first quarter GDP is tracking at 1.7. So just call it under 2%, which is much lower than the fourth quarter. And then as bullish as you become on the U.S. economy, you're staring at this massive fiscal cliff in 2013. It's unprecedented. It's anywhere from 4 to 5% of GDP, where we need D.C. and politicians to and enact various rules and tax sunsets and alike. So there's a really big decision upon us here.
There's a number of ways to go here, but let me first talk about there is a doing of it, giving your caution. What's the to-do list for Morgan Stanley now?
The to-do list is to take risk down and add hedges. So that's what we've done. So there's three main things that we've done over the past couple weeks. First is that we've collapsed or taken down pretty meaningfully our long Italian, short France sovereign trade. The second is that we've also collapsed and taken down meaningfully our long European equities versus U.S. equity trade.
Interesting.
And then lastly, we also took down pretty meaningfully our financial credit trade, which has been one of our favorite trades for quite some time, particularly in Europe.
Is the distinction in Europe, and again with Joachim Fell's important note that everyone reads coming out Sunday afternoon in his argument about complacency, tying that into Robert Feldman's work in Tokyo, is this issue of complacency an issue of a shock, an exogenous shock to Europe that leads to greater recession? Is it a real economy worry, or is it a financial economy worry?
It's a little bit of both, honestly. But I do think complacency reigns supreme here. What investors have looked past Europe, I think that's a mistake. And so I think it's a perfect time to really reduce the risk.
Let's go back to the United States. Bring up this chart, if you would, here, and then I want to get to Barry Ritholtz's comment. Here's corporate profits. Corporations win, labor loses. Well, forget about productivity, but this has been the missed call. Corporations just keep generating profits. Is it a single-digit earnings growth for corporations, or are they going to surprise us once again?
Well, clearly, we've been surprised for a couple of years now at the productivity miracle, but we've seen that starting to flatten out, and I think that's really important. And so productivity has actually moved downwards to more cyclical type of levels. And our belief is that corporates have actually out-earned their normal capacity. And I do think there is a catch-up, and that'll manifest itself in earnings growth, margins, and alike.
Okay.
And what's good for the goose isn't necessarily good for the gander, and that's what we've had from an economic standpoint. No hiring, no capex.
Interesting. Earlier this morning, folks, on Bloomberg Surveillance, I spoke with Barry Ritholtz of the Big Picture, and I asked him what signs he sees pointing to an up market, a non-cautious market.
I started as a trader, and one of the first rules you learn is it's not the news, it's how the market reacts to the news. And we've had a slew of pretty mediocre news. It's all been disappointing, and the market has shrugged it off. When you see that reaction to bad news, it's hard to be bearish, at least over the next 30 to 90 days.
This was a great conversation, folks. Here at Bloomberg Radio Plus out on iTunes. Greg Peters, Barry's in your camp. He's got a list of cautions, a list of worries, but he says, and there's the market just grinding higher. Is it because of a lack of volume? Is it because the hedge funds were out of it in 2011? What's the why of bids up?
I'm not exactly sure, but I agree with Barry's comments that the market has not reacted the way that I would have thought necessarily. But I think it's about central banks, honestly. What I think is about the belief of the Fed's always going to be there, and other central banks are always going to be there to provide the floor and the backstop. But that was the same thesis last year. And so keep in mind that this is a thesis that has repeated itself year after year, yet we've always entered this volatility storm. So it's a matter of time, I think.
Does Vincent Reinhart stand by his 3 out of 4 chance of QE3?
Yeah, absolutely. Well, do
you guys argue like you used to argue when Steve Roach was around?
Well, Steve's coming on the show, so I have to watch what I'm going to say. But no, we absolutely debate, we absolutely argue. But I think Vincent's call isn't about QE necessarily, it's about just policy. So he thinks it's 1 of 3 out of 4 for QE or Operation Twist.
Very good. Never enough time. Gregory Peters, thank you so much.